We have a very special guest joining us now to run us through what he's making of things. Someone really who thinks out of the box, and his views are a pleasure to read. Viktor Shvets is Managing Director and Head of Global and Asia Pacific Equity Strategy at Macquarie. He joins us to take some questions. Viktor, great to have you with us here. Thank you very much for your time. We're having you back on this program after a long time. Just contextualize for us how you see what markets are pricing in. I'm talking about the US markets, world markets. Are they now pricing in a sharp slowdown ahead? And what does that mean?
Thank you for having me. I don't think the markets right now are pricing in a recessionary or global recessionary scenario. Globally, in order to be in a recession, global GDP should be growing below 2.5%. Right now, markets are still pricing in a global GDP growth rates of more like 3 or maybe a little bit above 3%. Now, why is it different? Because if you are skirting recession rather than going into global recession, you're likely to get earnings per share growth rates -5, 10% against current expectations, which globally is still around 8 to 10%. But you also are going to have much higher equity risk premiums, or for that matter, debt risk premiums. So yes, it's true, in the recession, risk-free rates will go down, but risk premium will jump massively. And so what you're going to get in a recession is much lower earnings per share and much lower multiple. So when people are discussing potential downside on SPX of about 3,000 or less, that's your real recession. But if you're skirting recession, in other words, global GDP growth rate somewhere between 2.5% and 3% rather than 2 or 2.5, then it's different. Earnings per share growth rates globally probably will be in low single digits, something similar what we saw in 2015-16. What you find, risk-free rates will go down, but equity risk premium and debt risk premium will also go down. So the multiples will improve. So that much more limiting your downside. So right now, the market is still pricing, skirting the global recession, but not having a significant recession, as I said, over the next 12 to 18 months. You would need substantially worse numbers globally in order to get to actually to that stage.
Okay, markets are pricing in the economy skirting a recession, but not a full-blown deep recession. What are the chances? Sure. What odds would you put to we getting a full-blown recession, Viktor?
It all depends on the public sector policy. My view remains that all central banks globally will start changing their monetary policy by the end of 2022. And when I say changing the policy, we start with communication. You find communication policy will start changing at the end of this year. As we go into 23, my view is that interest rates will be cut, and QT will be converted back into some form of QE sometimes through 23, probably the middle of the year or later. And as we progress towards the end of 23 and into early 24, in my view, all of this compression of fiscal deficits that we're currently experiencing in most countries will reverse itself. And as we go into 24, fiscal policy will also become more proactive. So if this policy outlook is correct, that is, both monetary and fiscal policies are going to change over the next 12 months. Then you're going to skirt the recession. You're not going to have a fully blown recession. This, of course, very much contingent on inflationary outcome. My view remains that what we're seeing is a disruption of the global goods, services markets, commodity markets, and labor markets, but it is not an embedded inflation. Now, if that is the case, then my view remains that inflation globally will start coming off quite rapidly over the next 12 months. And that will offer an opportunity for central banks and fiscal authorities to become more proactive. Okay. Clearly, if I were to alter those assumptions, either in terms of inflation or in terms of policy response, then clearly a much deeper recessionary outcome could be possible.
Viktor, good morning. But 12 months can feel like a lifetime in market, right? So, from the equity market point of view, how do they price this event? Do you think we break the recent lows, perhaps go through more time-wise bear market rather than a price-wise bear market? Or do you think the market now makes some kind of a bottom and starts to move higher? Your thoughts?
Well, again, it comes back to financial condition indexes, because at the end of the day, central banks will always react whenever financial condition index tighten too much. And where you're going to see it is in a high yield market, where you're going to see it is the plumbing of the banking system, where you're going to see is the volatility of the currency in the bond market. As soon as you see this tightening, and remember today, for example, in the US, we basically just tightened back to financial conditions pre-COVID. There hasn't been a considerable amount of tightening yet. But as central banks keep moving interest rates up and draining liquidity, volatility of asset prices will increase. So the next 3-6 months, in my view, will be pivotal. The market will have no clue which way to go. And so you're going to have a rapid shift from up to down without any particular reason. And what the market is waiting for is a change in the policy setting. And so in the next 3-6 months, we will know the answer. And my answer is they're going to change. That implies that sometime in the next 3-4 months, you will find the bottom. That's probably when your leading indicators will be bottoming out on a global basis, and when your inflationary expectations will be topping out and coming off.
Okay, so when you say that the monetary policy will start accelerating in 2023 and there could be perhaps a reversal of what we're seeing currently, is this, Victor, a great time to be putting money to work, especially in some of the emerging markets which have an additional tailwind perhaps of, say, things picking up in terms of the post-COVID era? We have consumption that is on an uptrend. Crude prices are now starting to stabilize a bit. So if you had to put fresh money to work, where would it be?
Well, the interesting thing, emerging markets are actually performing very well and have been for the last 7 or 8 weeks. They've outperformed developed markets by anywhere from 7 to 8%, which is reasonably good move. In a sort of environment where we're debating the extent to which we're going to have recession, in an environment of rising interest rates, declining liquidity, and what I usually describe as a pincer movement of rising US dollar and falling yen, normally you would not expect emerging markets to perform. And the only reason the performance is there is China, because China is totally countercyclical to everything else globally. And finally, China is starting to move. But the rest of the emerging markets, particularly those emerging markets which purely terms of trade, things like Indonesia, South Africa, Brazil, Malaysia, they already had their day under the sun. The cyclicality already peaked, commodity complex already peaked, inflation already peaked. So those countries will be eroding. I think the same applies to quite a number of opening up plays as well. Now, India is interesting because India, for me, remains the most interesting long-term emerging markets. But in the short term, there is quite a bit of headwind. And so some of the resilience that Indian equities have experienced might become less pronounced. So when you talk of emerging markets, one has to be a little bit careful, because Northeast Asia, Korea and Taiwan will have a cyclical headwind over the next 6 months or so. You find the cyclical terms of trade countries will have a headwind. I think India has quite a number of issues. So when we talk about emerging market performing, to me, it still remains basically China, at least for the next 1 or 2 quarters. I think China will drag up emerging market indexes, and China where performance will be. But longer term, if you start looking beyond sort of the next 6 months, I agree. You would need to revisit some of the terms of trade countries, probably later in 2023. And I think India pretty much checks all the boxes that I would like to see in emerging markets longer term.
In fact, that was my next question, Victor, because the two concerns for India last year were A, commodity consuming country, and B, high valuation. And it looks like both these headwinds are now getting out of the way. Valuations have corrected and it looks like commodities have peaked out. So do you still wait for 1 year or so, or do you sort of start to at least put some money to work here?
Well, I'm overweight India, but I am also overweight China. I think in the next quarter or two, China will perform better than India. As I said, that probably will last towards the end of the year. After that, I think India will pick up performance. And later on in 2023, I think it's going to be a sort of turn of more terms of trade-driven countries. India, in many ways, is kind of a lucky country, because what you would like emerging markets to have is a very large domestic market. India has it. What you would like to see is limited degree of globalization. India has it. What you would like to see is build up liquidity within that market and some capital controls. Again, India has it. You would like to see industrial and digitalization policy. Again, India has it. And you would like still to see some structural reform. India is always two-step forward, one-step back, sometimes two-step back. But compared to the rest of the emerging market, there is a lot more going on. And the final point about India is that it is not Russia, Turkey, or China. And as investors increasingly demand emerging markets indexes excluding some of those countries, I think the importance of India will increase. So perhaps next quarter or two belongs to China, but beyond that, yeah, I think it will be India.
Victor, I just want to sort of rewind back a little bit to what you said, just to clarify a couple of things, if you'll bear with me. So when you say that the central banks will start to reverse cut rates, etc., they'll do that at what point? What would the Fed funds rate be, according to your mind, by then, when they start to reverse? Would it be 3.5%?
Well, it all depends on the neutral rate. Now, in the United States, the general consensus is that neutral rate is about zero, just above zero in real terms. Now, that implies that nominal rates are about 2.5%, maybe 3% at most. Now, so in other words, we still have at a minimum another 100, 150 basis points to go before you reach neutral rate. The problem, however, as you get closer to neutral rate, as you add another 50, 75 bips and another 50 bips, and you get very, very close, what's going to happen? Volatility of asset prices will increase dramatically, in my view. And financial condition index will start tightening quite significantly. So I'm not in the camp that there is another 5 or 6 or 7 tightening cycles at all. I think we're already pretty much at the peak or close to the peak of 10-year money. What's going to happen if you continue to tighten, the yield curve, which is incredibly flat all across, will start inverting. And you can't really leave an inverted yield curve for any length of time, because that's essentially will start precluding credit creation within the economy itself. Okay. So I'm not in the camp of going 3.5%, 4%. I think neutral rate 2.5 to 3. And if you try to go beyond the neutral rate, I think financial conditions will tighten too much.
Okay. So 2 questions then. One is, so the 10-year is already at 3, right? Over 3. So have yields peaked to your mind? Second, our stock markets, where do you think the S&P will get to? Or you think we've already seen the bottom? I mean, it's already basing out now where it is. And third, well, just one last point. Yeah. What is the risk to this call? I mean, is it possible that the view that you're laying out is wrong? And how could it go wrong? Go on.
Yeah, well, probably the most important thing that can go wrong is inflation. That's your key. Because my view is very simple. We were not running out of people or commodities or goods in January 2020. Why are we running out of all of this today? It's not the demand. Demand is basically returned back to trajectory. In other words, demand globally is barely returned where it would have been if there was no COVID. So why we were not worried about any of that 2 years ago and why we're worried today? So to me, it's basically mismatch of demand and supply. Demand and supply curves are not moving in unison. It's disruption of the goods market, then disruption of the services market. On top of that, you overlay geopolitics, but it's basically not something that is embedded. Now, if that is the case, if that is the right answer, then essentially, if you think of G5, which is a proxy for global CPI, if you think of G5 CPI, it's really peaked at around 6.5%. In my view, unless we have either a massive geopolitical disruption or massive healthcare disruption, or unless we have fiscal policy expanding rather than contracting, those numbers will fall off very quickly as we go over the next 12 months. In fact, you can have a bullwhip impact of diminishing demand meeting an increasing supply. And so that's your core. If that doesn't work, then nothing else works. Essentially, you will have to step back and you have to break the furniture. And that's when you start getting into a really severe recessionary scenario.
Has the S&P bottomed out, Victor? Just the other point. I mean, let's just consider for a moment that your view is how it pans out. Given that view, has the S&P then bottomed out?
Well, if my view is correct, the most dangerous period is the next 3-6 months, because that's where policy errors are committed. Why would you be tightening when a global economy is already receding? All leading indicators have been falling for at least 6-7 months. Money supply is now in a low single digit on a global basis. You have copper prices falling, industrial commodities falling. You have inflationary expectations which are already receding. Why would you be tightening into this? Fiscal policies are becoming very regressionary on a global basis. And so the next 3-6 months is a period of potential policy errors. Now, that's your most dangerous period. If my view is correct, what's going to happen, then if you think of SPX, for example, it's now equidistantly positioned. In a sense, your maximum downside is probably 3,600, 3,500, your maximum upside is 4,500. If, however, you do go into severe recession, that's where you start talking of SPX at 3,000 or less. Now, that implies that sometime in the next 2 to 3 months, maybe 4 months, you will find an extremely good opportunity to enter most of the markets. And as I said, policy setting will become supportive as you go through 2023.
Okay. Actually, you've answered most of our questions, but in any case, just a couple of more questions that I have. You did mention that, for the next 3 months, China looks like it could be a good market, but for the long term, the Indian market is well placed, or better placed rather. So for India particularly, which are the themes that you think could evolve over the next, say, 6 to 12 months? Because we're seeing big drawdowns in IT. On the other hand, banks, financials are doing very well. What do you think would be the big theme for an emerging market like India?
Well, generally speaking, for India and a lot of emerging markets, it's all about ability to grow. It's all about ability to create middle class. It's all about ability to create consumption, stimulate consumption. Now, most emerging markets right now have a problem insofar as globalization is going backwards, trade is going backwards, capital is becoming more scarce rather than ample. And so what you want to look for is a domestically oriented market with a large domestic market. And what you want to see is the ability of an ability of monetary authorities to stimulate. Again, not many emerging markets can actually do stimulus. India has to be careful because there is a constraint on the debt to GDP. There is a constraint of credit agencies. But generally speaking, India has a great opportunity to do that. So for India, therefore, you have a variety of themes. You have digitalization theme, you have industrialization, reshoring theme that you can invest in. I think IT theme is going to come back quite quickly. You have a consumption theme. So there is a plethora of themes that are quite interesting and viable, in my view, that you can invest in, which is quite different to other emerging markets, where you're either placing your bets on terms of trade and external accounts and external businesses, or alternatively, you are committed to very narrow lanes, like, for example, high-tech lane, and that's about it. So India has a variety of themes that I think will play out quite well over the next sort of 12, 18 months.
Okay. Now, Victor, getting back to the last point you made about the most vulnerable period, right? The next 6 months. If there's a policy mistake, if there is, which asset class is at highest risk? Is it the US housing market? Is it commodities? Is it equities? What, to your mind, is at the biggest risk right now?
Well, if we have a severe recession, clearly what you're going to see is much lower goods demand as you go forward. So everything that benefited from a very dramatic shift in the goods demand will be a negative. And that includes all the cyclical elements. It includes financials. It includes value. So in other words, if we go into recession, why would you buy value in cyclicality when you are just about to slow down in a quite a massive fashion? So what people will start looking for is much more quality sustainable growth. In other words, good balance sheets, good cash flows, good margins, resilience. Now, there are other things one could discuss in addition to equities, and that is foremost the high yield market. Yes, the spreads have increased in the high yield markets from about 3% to 5%, but in a stress situation, that could easily be 10. If you think of triple C debt, yes, it's gone up from 6 to 10%, but again, in a distress scenario, you could see those yields going up, or spreads, I should say, going up to 20% or even more. So there are other pockets, apart from a choice between cyclicality and quality and value, that will be vulnerable. There is a question mark over private equity, which has grown to be $11-12 trillion market globally. Again, they are usually much slower in repricing the assets. But if the public market will continue to retreat in recession, let's say SPX to 3,000 or less, then potentially there is problems brewing in a private equity market as well. So there is a variety of things. I don't believe mortgages will be the major issue this time. It's going to be much more digital assets like cryptocurrencies. It's going to be things like private equities, parity trade. I think it's going to be the high yield market. And I think the major beneficiaries of cyclicality will be the other sort of negatively impacted. You should be looking at quality sustainable growth, even revisiting thematics.
All right, Victor, we'll leave it there today. Thanks a lot for joining us. And like you said, perhaps it's not time to be fearful. That could well be the time to look forward and look at what the market may do in 2023, provided there's no policy mistakes over the next 6 months. We'll take a break. After that, we'll talk about stocks. Our list of top 10 stocks lined up next.